Yeah. All right, get the socials up. Hello, Smart Energy Podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Phil Weiss. Hey, Phil.
Hey, Kirk, happy to be here on this Friday.
Happy Friday. Just getting ready to go on vacation, enjoy myself. Feel like the summer, been on vacation all summer. It's been very light in the markets and the news, and well, not the news. I mean, if you're following the war, every day is an adventure. But besides that, things have kind of slowed down quite a bit.
They
Even on like social media, I've seen like a lot fewer interesting stuff and interested people. Like all the people that are always posting, like in the last few months, just seem like very, very few. So I think everybody's just taking it easy, which frankly I think is probably a good idea.
yeah.
Got to rest up for the upcoming storm.
Yes. Besides, you can go crazy trying to follow all that stuff. It's good to take a break.
Yeah, it sure is. It sure is. It's healthy to take a break once in a while. It's if nothing else to reflect and to, I tend to do this in December. I do this with a lot of advisors and some CPAs. We do kind of this year-end process called Best Year Ever, where we just kind of walk through a framework I've developed over the years to really be really productive over the next 12 months. And if nothing else, it's really good for just taking stock and where you are and what's important to you, what's not. I find it to be really helpful. It's one of the best things I've ever done, and now I do it every year because it's so powerful. But the point being is, summer's similar, right? I mean, was it 6 years ago? I think it was. It was the first time I kind of noticed this. Is like 4th of July when it happens on a Wednesday. Half the population doesn't go to work in the few days before the 4th, and the other half doesn't go after the 4th. So it's like, why don't you take the whole week off? Like, what's the point?
Yes.
Same thing around December, right? You got Christmas and New Year's. They're a week apart. So if they're in the middle of the week, it's great. I think this year was on like December. I mean, I'm sorry, it's on Friday, so that kind of sucks. But middle of the week's great because just people aren't around and everyone takes it off. But generally speaking, in the summer, it's a good time to do things like catch up on reading and projects and just really focus down on getting caught up and less stress. So that's what I'm doing. That's taking next week off and trying not to do any work, but I don't know. I don't think anything's going on in the market that's warranting enough to pay close attention. But either way, cool. So we're diving right in this week. Not a whole lot to talk about, but I definitely want to go over a bunch of stuff. There's some interesting stuff here. Before I dive in, Phil, what are you seeing out there? You had an interesting note before we were starting taping today.
In general, it's pretty quiet, but there's actually news came out this week that I thought was kind of interesting because it was something I hadn't seen before. And there was an article in the journal about this. It was on, I guess it was written Wednesday night, so it was the 11th. And so today's the 14th. It had been written Tuesday night. It must have been in Wednesday's Wall Street Journal. But it was talking about a different financing vehicle that they're using to fund a lot of what's going on in AI. So the AI boom in general is requiring a lot of capital. And you have companies like Google's done some things different. Google issued stock. There's debt being issued. Companies that were free cash flow positive. And for those that aren't familiar with that term, free cash flow refers to if you go to the cash flow statement and you take cash flow from operations, which is essentially earnings adjusted for non-cash items, and then you subtract out capital expenditures, that gives you free cash flow. And so Google has historically been free cash flow positive, and I think they just for the first time ever were not. So they have to fund this. And one of the things that companies were doing was something that we saw back in the dot-com bubble, where you basically had the companies were doing the equivalent of vendor financing. They were basically financing the purchases of their product by their customers. That works as long as the business is going and growing and things are going well. But as we saw in the dot-com bubble, that doesn't always work. Like Cisco and Lucent, which is no longer in existence because it went bankrupt. But some of these companies, Nortel was another company that had problems with that. But these companies were financing the purchase of their product, and then when their customer couldn't pay, basically the items got returned to them. So instead of doing that, they put together this structure to finance AI deals. And basically, what happens is investors buy debt and they put money into this special purpose vehicle, an SPV. That's that's where the cash goes that the investors put in. Then that SPV uses the cash to buy the equipment, and then the that SPV leases the equipment to the customer, and then over time, because the equipment being leased, the customer pays the SPV, and then the investors get the cash back. So instead of having companies like Nvidia funding purchase of their own things, they're getting outside investors to fund this. And so I thought that was interesting. I know there was a big meeting about this where a lot of the investment banks and the big financial players were part of it. I know Larry Fink from BlackRock, he's talked about in the article, and there were other companies involved. I've heard it. I've seen special purpose vehicles before. I haven't seen this particular structure. I don't know what kind of returns they're anticipating or expecting the investors are going to get, but there are a lot of different debt vehicles that are out there. This is just a different one, but this is not something that I'd seen before, so I thought it was kind of interesting. And so it's possible that, you know, Nvidia and companies like that could use their balance sheet to backstop part of the cost of the project, so it's not like they're totally going to be out of it. But it is a way to get some outside cash to fund these things. And basically looking for outside investors to help fund it. I guess think about it. If Google's issuing stock, they're looking for outside investors to fund some of it too. So it's not totally different, but it's just a different way. And so they're asking investors to put money in to get a return in a form of lending to, you know, and investing in the AI pool.
Yeah, I mean, let's talk about this for a minute because I think Phil brings up a really important point. I'm glad he noticed the article. You know, when you think of companies when they're growing, right? When a company's growing, it grows mostly in cash flow, right? You have more revenue, you have more money to spend, right? And you know, so if you're growing at 20% a year, and that means you can, assuming all your ratios are the same, assuming you're keeping everything proportionally the same. If you grow revenues 20%, most likely you can grow your expenditures 20%, right? So you know, if you think about companies that need to grow rapidly, like AI, they need to grow as fast as possible. You know, if your revenues are growing 100% a year, which some of the craziness going on, let's say they're growing 100% a year. Well, let's say you need to grow like 400% to, you know, to basically build in capex and build plants and all the stuff that's necessary. Well, where do you get the money? And this is part of the problem with this like rapid growth that happens is that companies are forced to find other methods. So normally you use cash flow to pay for things. But let's just say you need to build a plant. Plants aren't cheap. It might take 10 years to build. You know, it's really, really expensive. Well, most companies will borrow, right? To build a plant, let's say $1 billion plant, and then they'll borrow whatever, let's call it $1 billion to build that plant. Well, there's reasons they do that, but realistically, that's probably a good investment, right? Because you're paying 3% a year, whatever you're paying on that, you know, debt, and it's going to deliver 50% returns a year, you know, once it's active. This is the kind of financial shenanigans companies do, right? It's just arbitrage, right? I'm paying 3%, it's going to deliver me 50% returns, you know, in 5 years. Okay, that's an arbitrage a lot of companies are willing to make. And so a lot of companies will use debt to grow because they have to grow in a lumpy way, right? Now, if I was to build $1 billion plant, I can't do that, right? Because I don't have the financials to support that. And it's, frankly, I don't need one, but let's just say I needed one, right? I needed a plant for something. And, you know, I need to be able to support the payments, right? So when companies are growing, like just say I'm growing and I need, let's say I need a new office, right? And I want to borrow money to go buy a new office, right? I could do that, right? And I would have to be able to support the payments to do that. But if I'm going to be able to hire a bunch of people and they're going to produce, that's going to lead me to produce like 50% more. Well, yeah, that's a good deal. I'll pay 8% a year on that loan, and you know, I'll get these huge returns. So it's really important to understand what these companies are doing. Now, normally they use debt because, especially tech companies, you can borrow at a low rate. And some of these rates that you see these bonds out there are like 1% or less. Not now, but they were. But let's say you're getting 4% right now on debt, and they can grow at 50. Okay, that's probably the best for fast growing companies. And also because the debt will, if you're borrowing $1 billion and then your company grows to like $1 trillion, well, that billion's nothing, right? In the grand scheme of things, right? And so that's part of it. Now, let's just say a company's issuing stock, because that's another thing they could do, right? They could borrow money for growth, or they can issue stock. Well, why would you issue stock? Well, frankly, you issue stock because your company is really, really overvalued. So I would not, if I have a company, right? I have my company, and let's say I'm growing, and I say, all right, I need to raise capital. Hey, Phil, why don't you buy some of our company's stock? Screw that. Hey, Phil, lend me some money, right? Because I'm going to outperform that fixed rate. But if I'm issuing stock, it means my stock is way overvalued. Hey, Phil, why don't you buy my shares at $100? Well, it's probably worth like 50, but why don't you buy it at 100, right? Why not? If you're going to overpay, I'll issue you stock, right? I'll happily do that. Because let's say you got a PE of 100, it's going to take you 100 years to make your earnings back, right? I mean, effectively. So yeah, sure, I'll give you a PE of 100. Phil, go right ahead, take my stock, right? Because it's overpriced. So when you see companies issuing stock like Google did, it leads me to believe it's way overvalued. Why would you issue stock unless you couldn't get more debt? And I'm sure Google can get as much debt as they want. So you have to understand, like, why are companies doing certain things? If you looked at, I think it was AMC during the meme stock bubble, it went crazy. And what did they do? They started issuing stock. And people were like, great, more stock. And all the memers are out there like, oh, great, it's great, it's the greatest thing. And everybody who's half intelligent was like, those dumbasses, like they're going to get liquidated. And that's exactly what happened, because they kept issuing stock at these ridiculous prices. And what happened? The price got capped. Because all you're doing, if there's 100 shares out there and now there's 500, well, you need 5 times more people, investors, to support that. And of course, there's the same amount. So it diluted them. And all of a sudden, the stock started dropping down to really low levels. Because the more stock you issue, the stock can't continue to decline, because the volume of interest is getting diluted with the shares. So that's an obvious example that happened in the last 5 years. And like all the smarties just kept selling call options because they're like, this is stupid. It's not going to keep going higher if they keep issuing shares. So they sold call options and did pretty well. But let's say a company like Google, they're issuing shares. Well, for me, that's a tell. Google's not dumb. They're smart people. Why are they issuing shares? It means they think their stock's overpriced. It means they can get away with it. So that to me is a sell signal on Google. Now you've seen since they did that, Google's stock price hasn't gone anywhere. It's been pretty much flat. It went down actually initially when that happened, but now it's just kind of flat. I would be suspect of companies issuing shares. Now, Phil talked about what happened back in the .com bubble, where people were doing vendor financing, which led to a whole lot of shenanigans. And Enron being a big name one. I can't remember if WorldCom was involved with that too, but
WorldCom had its own issues.
I know they had their own issues, but I don't remember if it was that. But there were a bunch of companies that got involved with that and either went bankrupt or there were criminal actions either to the company or the people. So there was a lot of shenanigans. Let's call it shenanigans. Let's just
WorldCom shenanigans, if I remember right, was that WorldCom was taking expenses and treating them as if they were capital asset purchases so that they could depreciate instead. So that obviously gives them a better earnings picture, but it's a shenanigan that's not real. It's not true.
Yeah, Phil's a tax expert. I'm not, and I just call them shenanigans because, to me, it's all the same. It's something you don't want to see. So it doesn't matter if it's point A or point B. It's shenanigans, and you don't want to see shenanigans. You see them, you go the other way. That's my non-accounting framework that I use to assess companies. There's shenanigans or no shenanigans. But to Phil's point, though, look, I'm being a little facetious, but honestly, for most people, we're not accountants. So you can't get caught up in the weeds of, well, this person says this. I don't know if it's going on or not. It doesn't matter. Is it shenanigans or not? If it's shenanigans, you have to be cautious. It doesn't mean you run away from the stock, but it should give you a pause as to whether you invest in it or not, right? Maybe you don't buy the shares, maybe you buy call options, maybe do something less risky. I mean, whatever it is, you have to figure it out. But my point is you don't want to see shenanigans with a good company, right? Google's a good company. We're starting to see, I wouldn't call it, that's not shenanigans, but you selling shares is actually normal, but it's something that would give me pause. Not in the way that I criticize the way they're doing it. As an investor, it would give me pause that they're doing that. Now, if they're doing vendor financing, that certainly gives me pause. But I guess if you're investing in a rocket ship going straight up, you're not worried about financial shenanigans. You just want price movements. So, most people are there because of the adrenaline rush, not because of the accounting. But it's one thing we should. One second, I'll give it back to you, Phil. One thing we should note is that we've heard in the last 12 months from notable people that there are accounting, we'll call it gimmicks or shenanigans that are going on. And it's not saying they're illegal. I'm not saying any of them are illegal. They could be, I don't know. But I'm not suggesting they're illegal. I'm suggesting they're shenanigans, which means that if you resort to shenanigans, it means that, all is not well and good under the hood. And that there could be further problems. Like you can't get people to pay for your goods. Either they don't have money, or you need to somehow figure out a way to pay your creditors, or there's a disconnect in the accounting mechanism. Between the input and the output, there's a disconnect somewhere, and you're trying to cover your tracks with, we'll call it creative financing, right? Now, there's this thing called factoring, which is creative financing. You don't use factoring if your company is sound and your cash flow is sound. Use factoring if effectively you can't thread the needle between revenue and expenses. You're basically getting paid upfront for inventory that you haven't sold yet. I believe is what factoring is. I have to go. I don't do factoring. I'm always fascinated by it. I think if you can invest in factoring and you're good at it, the returns can be great. But for most people, like 99.9% of the people, it's not something you should do. But I'm always fascinated with it because business owners resort to that. It means like they can't get a loan, they can't get money from friends and family. It's literally like a last resort kind of a thing that you're doing factoring. It's like going to a loan shark. It's not that bad, but it's kind of in that ballpark of questionable. Like if you're doing that, what's going on? There's nothing wrong with it, but if you have to resort to that, you know that they're in trouble somewhere. And it doesn't mean it's always bad. It just could mean that there's a huge disconnect in cash flow. But it is something you should take note of, right? If you see it, you're like, what am I missing? Same thing with vendor financing. What am I missing? It could be okay, but you need to do the research. So go ahead, Phil.
So first, when I think of factoring, I think of it around receivables, not inventory. And so, for example, if I sell something to you and you're supposed to pay me within 30 days and I want the cash sooner, maybe I want it in 10 days. And so I factor the receivable. I sell it to you. And if, let's say, you owed me $100, or the customer owed me $100, you give me $98 for it today. And then they collect the 100 at the end. So that their margin is the difference between what they paid you and what they ultimately collect. So it's a way to get money in your hand sooner. On the issuing, yeah, it's kind of like a loan,
but secured.
But it's supported, right? It's supported by the receivables. The other thing to keep in mind, though, when you're talking about issuing stock versus debt, is sometimes companies are doing it to protect their balance sheet too, right? Because companies have a debt to equity ratio, and if we issue too much debt, then our debt to equity ratio gets higher because we have more debt, and that impacts our credit rating. It can impact our borrowing costs and things like that. So they can also do it because they're trying to protect that and get a good mix. And then just like another company that did that recently was this week, Intel, which I don't know anybody that's followed that stock. It's been like a rocket ship too over the last year or so. They issued $20 billion, I think it was $20 billion of stock at a price of 95 when the stock was a little bit higher than that. because usually when you issue stock, the person that's buying it gets a discount from whatever the current price is, and they did that to help fund their AI growth. So again, it's AI that's driving this. But I'm looking right now, and Intel's trading at a little almost $103 a share. So while the stock initially went down on that news, now it's back up because of other factors. But it's just another way. It can be a cheaper. Like, I understand. Like, if I think about basic corporate finance theory, I should only issue stock if I think my stock is overvalued. I should be buying back stock if I think it's undervalued. But companies don't always act in that rational way, and you'll see companies like they're repurchasing stock to offset dilution because they have stock options and things like that that they have to pay, and other reasons. But in this case, these companies are doing because they're trying to protect their balance sheet. I think that's a big factor in it as well.
Yeah, and it's a great point. It's not always obvious. It's not always they don't have enough money. It could be protecting balance sheet. I mean, there's a reason these companies have like a horde of accountants employed, because it's so complex. But I look for simple things, right? If you have somebody like Phil who has an accounting background, Phil can go through this with a fine-tooth comb and find a needle in a haystack. For the rest of us who don't have that kind of background and understanding of accounting, we have to rely on simple frameworks, simple mental models that we use to see, is there something rotten in Denmark, right? Is there something here? Is there something there, right? To check out. So I look at simple frameworks like, are they resorting to shenanigans? If they are, that's going to give me pause, and that's going to cause me to say, all right, what am I missing, right? If the CEO does, if the company, if a company, let's say Intel, gets money investment from the government, I mean, nowadays, if the government gives you money, the stock goes up tremendously. But that gives me pause. Why is the government giving them money? Well, I mean, Intel is it's like the government supporting the car companies, right? If we don't have any car companies, then we're relying on other countries to give us cars. We don't want to be in that position. So we support, the two remaining car companies, even though, they haven't innovated in like 40 years. But, regardless, Intel is a strategically important company, right? And produce semiconductors. We need those. And, we can't rely on Taiwan, because if China invades, I doubt they will, but let's say they do, the whole world's screwed because they have like 90% of the semiconductor production. So we need to support that locally, which is what the government's trying to do. And the government invested in Intel, which I think is really a bad precedent personally, because that gets into, I don't want to throw this word around because everybody's going to throw around Hitler, but like, that's what fascism is, right? It's a combination of government and corporations. And so, it's not a good theme. It's not a good trend. And frankly, I don't think the government should do that, because even if you like Trump, what happens when the next guy or gal gets in and they take it, a different way, right? And then look what happened under Biden, right? I mean, they're basically telling Twitter how to control people, and they're telling YouTube how to control. I mean, then this news has come out that they, I forget which department, which agency did this, but basically the government was saying, no, you can't let that person on, or you need to mute this, or you need to do that. That's First Amendment violation. Maybe it's an end run around it, but in my opinion, that's a clear violation. The government did that. They're going to do it in the future because the precedent's been set, right? Even if Trump didn't do it, the next guy or gal will do it. I'm not saying Trump's not doing it, but let's just say he's not doing it, so someone else will do it because it's been done before. This is the problem with precedents, is that if it's done once, someone else will do it. Unless they went to jail, which never happens, unless they go to jail, then, it's going to happen again. So I think the challenge is now we've invested in public corporations. Well, Japan's been doing that for a while. They've been supporting their stock market. A lot of their shares are owned by the central bank. That started happening a while ago, like, I don't know, 6 to 10 years ago. But point being is, these are all bad precedents. So, you look for things like this and say, all right, it's good to stock price going up, but long term, I'm not sure if I'm comfortable with the government owning a company out. Maybe I am, maybe I'm not. I don't know. It depends on the government. But these are things you want to check out, right? These are things you want to see or not see in your investments. So these are the kind of frameworks to look for. And I don't need to know if Intel is going to survive or not. What I need to know is that the government's supporting them, and that is both a good and a bad thing. Good short term, long term, maybe gives me pause.
And going back to shenanigans for a second, when you find out the company, or you think the companies are committing some kind of shenanigans, they get upset. So when I was an analyst, I covered a company called Chesapeake Energy, which is no longer, it might still exist, but they went through bankruptcy. They had a lot of issues. And I found a lot of accounting concerns. And I had to sell on the stock when I was covering it. And there was Reuters was doing stories and investigating Chesapeake. And one of the reporters from Reuters would talk to me. And Chesapeake knew that she was talking to me. They actually asked her to stop talking to me and talk to somebody else that had a more positive view on their stock. And then going back to the dot-com bubble, I was writing for the Motley Fool. They used to have online portfolios. I helped manage one, and we had Cisco as an investment. And Motley Fool at that time had started a stock research service. And I had a really good relationship with the investor relations department from Cisco. And I wrote this really detailed research report on Cisco. And then we found out about their vendor financing. And like one of the things that Cisco did was I said, remember, if you sell something that you've basically financed, then the company goes under. And a lot of these .com companies went under during when the bubble burst. You get the equipment back. So Cisco got all these routers that they had sold back. And what they did is, because they got them back, they wrote them all down. They wrote down the carrying value on their books, and they treated them as basically almost worth zero because they weren't going to be able to be sold in a normal accounting cycle. And so one of the things I wrote about when that happened was that, look, they were still going to sell these. And because they took this write-off that everybody ignored, and then when they sold them, they'd have a better profit on them because they'd written them down to zero. And some of the other things that and I wrote about that, after that, when I tried to call Cisco, like the one that I spoke to was no longer there. But when I called Cisco, they wouldn't talk to me anymore. They refused because I had exposed some of the things that were going on. So companies don't like it when people publicly call them out for some of the stuff that they did. It's really not a good situation, but it's important. Like there's a lot of things that you can get if you want to spend some time looking at the company's details, but you have to have some knowledge and understanding of what you're looking at too.
Yeah, Phil raises a good point. I think back in the early 2000s, I read a book called Full of Bull, and it was written by one of the top institutional analysts. And I forget the guy's name, but let's see. I'll look for when Phil's talking next. I might have it on my wall. But the book was written by the guy had won like awards year in, year out for being like the top institutional analyst. And he wrote this book about basically the co-opting of the bias in analysts. And part of the problem, I mean, I think it was Michael Milk or what was the guy's name? It was like Milk or something, but he was a top analyst. Not Milken. He was in the financial sector. He's like the top.
Oh yeah. I know who you mean. Michael. It's with an M, but I forget.
I think it was Milk.
It might be.
It might be Milk or something. Anyway, so this guy, he was one of the top financial analysts at the time, and he called out some companies, and he basically got banned. And the challenge is when you're an analyst, you're trying to get access to public information, and you have access through annual reports and whatever, but they're also trying to get input from the executives because the executives have more insight and they can help disseminate information, and there's a benefit for them to do it because the benefit is you give it to the analysts and the analysts like you and they give you good ratings, and there's kind of this unspoken agreement that you're not going to shit talk me in public, and I'm going to give you access to stuff that you wouldn't ordinarily get access to. Not inside information, but just like direction and just guidance and hints and things. I didn't say that, but like you allude to it. There's this kind of unspoken conversation that goes on, right? And it's not my experience. This was written in the book. And so when that happens, there's a lot of incentive for analysts not to shit talk these companies, right? Not to have a sell rating. Right, as Phil's saying, like the incentive's there, and so if you do that, you get banned, and they don't talk to you. And not only that, they tell all their buddies that you're a bad guy, and they don't talk to you either. So, you kind of have to play game. You have to play the game. You have to play ball with them in order to continue to get access, or you get shut out. And if you get shut out, what good is you as an analyst? So I think the challenge that Wall Street has is there's this bias built in. There's a bullish bias. There's a buy rating bias. I mean, there's so very few sell signals on Wall Street. I mean, almost none. Like it's like maybe 1 out of 1,000. There's very, very few. Unless a company is pissed off Wall Street. Like I forget the name. It was one of those not wholesaling companies, but it was like a overstock.com. I think was the company. The guy who took that company public did it via Dutch auction at the time, which doesn't give Wall Street any investment banking fees. And so they were so pissed, they basically blacklisted him, and everyone has a sell rating on his company. They won't help him out. They won't issue. I mean, this guy has been totally blackballed by all of Wall Street because he took the company public without giving Wall Street their fees. So Wall Street says, okay, well, F you. And I forget the owner's name, but he's
Patrick
like
something.
Who is it?
It was Patrick. It was Patrick was his first name.
Patrick, yeah. You can look it up for me. I'll have to look it up. But basically the guy, he's a libertarian. He was just like, screw you guys. And so he did it. And Wall Street basically blackballed him because they didn't want there to be a run on everyone else doing this. They don't want other people to do it because they're looking at it. They're like, no, we're not accepting this. We want to make an example of this guy so no one else does this. So they blackballed him. So they always have sell ratings. They're always, I mean, on public media, they're shit talking. I mean, it was bad. I haven't heard of this company in years, but like I remember for like 10 years straight, like nothing but bad stuff. And this company was doing fine.
By the way.
What was his name?
Patrick Byrne.
Patrick Byrne. That's who it was. Yeah. And so, he was a notable story. He was a tale of woe that you didn't want to be that guy. And that's part of the problem, right? It's like government, right? You're a whistleblower and then they kill your family. Like, well, okay, no one's gonna be a whistleblower after that. Or this guy tragically commits suicide by shooting himself with a shotgun in the back of the head 5 times. Like, we see this stuff all the time, right? And it's done because it's to scare everybody else from not following that path. So this is why shenanigans are important, is why it's important to see how Wall Street actually works. And if you understand how it works, then you can look for these things. You can say, okay, I may still ride this stock, but I'm going to keep really close watch on it. I'm going to say, all right, what am I missing? Have I seen this game before? As Phil said, like, the games we're seeing now are you're getting SPVs to purchase stuff for the company. As long as they disclose it, I believe it's fine, right, Phil? I mean, as long as they just footnote it, it should be fine. But the question is, why do they have to do that? And, is this because they can't get enough money? Is it because they can't find people to fund it? Or is it because there's some other reason? I don't know. But it's something that you should ask and say, okay, what did I miss here? So, all right. Anything else before we kind of move on from shenanigans, Phil?
The only thing I'll add is if anybody's interested in reading this stuff, there's a book called, believe it or not, Financial Shenanigans by a guy named Howard Shillett, which is a pretty good book on the topic. And then there was another guy who I read a number of his books. His name was Charles Mulford, and he wrote several books around the idea of financial shenanigans as well. You have a copy? Because I know I have a copy. I can see it on my bookshelf too. But like, if you want to read about this stuff, financial shenanigans.
I got the book right here. Financial Shenanigans. It's on my to-do list.
I have a copy on my shelf as well. There's that, and then, like I said, Charles Mulford is another guy. He wrote a number of books, and he had some good things because there's a lot of games that companies can play, and these books are helpful in terms of giving you some tools to try to figure them out. Because there's some things, like when I'm looking at a company, there's some certain things that I look for that if they're present, they're that kind of red flag to stay away.
Yeah, if you want someone to really understand financials of independent companies, Phil's your guy. Like you want somebody with that kind of a background investing in individual stocks. You don't want some guy, some Yahoo sitting there saying, I don't know, it's going up, let's buy it. You want somebody with a little more thoroughness in their financial background. So we always appreciate yours, Phil. I'm going to share a little bit of what's happened in the last week, just to give everybody kind of an update as to what's going on in the world, as I think is important. So we talked about this last week. The S&P 500 broke out of their range. Now they're into the next range where we've got a little bit more upside, probably to close around 8,000, I think is the target on the S&P 500. It's still kind of summertime, so we got this kind of chop. It seems to be going up. People seem to be positive, but I can't find a person who can give me a reason why it's going up. So it's just more like, yeah, it's going up because it went up. Like, no, that's not really what we're looking for, but okay. So, we've got, there we go. Okay. Trying to figure this out here. Okay. They keep changing the settings on me. All right, so that's the S&P 500. This is the NASDAQ, still within a range, broke down, now it's up. And I bring up the three indexes because you want them to be in sync. If they're in sync, it's bullish. If they're a mess, then it usually means that they're still kind of digesting things. Here's tech; it's basically going sideways. It's still within the range. It's not overly bullish. I expect this to continue on the NASDAQ because there's a lot this energy from here to here, pretty much from April to May. Huge amount of energy, huge boost in the market, and then it just needed a break. So I'm sure it'll eventually go back up again. But look at this period back here, up until pretty much April, it went sideways from September of last year. It was like a 6-month period. NASDAQ went nowhere. And then it broke out and it shot up, and now it's in another range. I expect to be in a range for a while. When it breaks out, you probably want to be on board, but otherwise, you just want to be cautious. Russell's broken out. Russell's been in this trend. No one's talking about small caps, by the way. I mean, very, very few people. Small caps are having a day. I mean, look at this. They're doing great. So I think small caps are a place to be. It's something you want to check out and look into. Here's oil. You look at oil. This is the war, pretty much the war premium, and we're back down to 82 a barrel. We got down to 69. Where it started the war at 60, 66. Like, okay, I don't know what's going on, but the crack spreads are through the roof. And if you don't know what those are, that's basically what you're paying for gas. It's the spread between a barrel of oil and gas, and so we're paying that through the nose. But Gold broke out of its kind of doldrums here. I wouldn't say it's broken out. It's still within a kind of a range that's of question. I would be very cautious about being too bullish in gold yet. As you all know, I love gold and precious metals. I think they're great, but at this point, I would still be cautious because there's way too much energy burned off here, and we need to burn that off sideways. Sideways is bullish. If it keeps going down, it's not, but I think there's a lot of support at 4,000, so it seems to be. So we'll see. It may go back down there. It may even break below, but come back. I'm kind of waiting on that, but I'm not getting overly eager on gold quite yet. But I do think it's important to note that it has kind of broken higher a little bit, and it should be noted. Copper's still something people want. People want to build. It's it's been in a good trend, and it's definitely, you can kind of look at this triangle pattern. That's actually pretty good. You want to see it break out higher. If it does, you want to be on board copper, but it's hard to invest in copper, so it's not the best. It's not the best commodity. Bitcoin, you see here, we talked about this last week. Nothing else has changed. It's still within this range. People got excited last week, and then they're not excited, which is kind of the Bitcoin parade. But I would be a little cautious here going to the end of the year. I still think we're going to sell off tax loss selling at the end of the year. That would be my thesis. It may not happen, but who knows? I mean, we've still got some legislation going into the government on crypto, and that has not gone forward as of yet. We have the Kospi. There was a lot of news on this in the last few weeks. It got taken to the cleaners. It was down 50%. It was 30% in a short period of time. I tend to stay away from Korean stock market. It's not very well diversified, but it's fine if you're into that.
It's like all semiconductors, isn't it?
Yeah, there's like if you look at the it's EWY, I think it is, the iShares South Korea index. It's like 40% in two stocks. So it's like Samsung and Highlight. I forget the name of the company.
Yeah.
It's like high something, but
SK Hynix or something.
SK Hynix, that's what it is. Yeah. Yeah. So those two companies pretty much. And so I have no interest in that. It's just too much concentration. Here's the Nikkei. That's a good trend. You should definitely pay attention to the Nikkei. That's a Japanese stock market. Ton going on there, not being talked a lot about because it's not the US, but it is. There's a lot of good stuff that's been going on there for a while. Big fan of Japan. And here's the 30-year, not doing great. And interest rates are going up, and they're kind of stuck where they are now. But people are very bearish on bonds at the moment, and rightfully so. If we have higher inflation, interest rates are only going to keep going higher in the long end. The Fed can control the short end, but not the long end, as they say. But I read a stat the other day that kind of surprised me. The long end is actually there's not a lot of inventory because they stopped issuing 30-year bonds. When did they do that, Phil? Like 20 years, 25 years ago?
It's a while.
So they don't have 30-year bonds anymore, technically, because they stopped issuing them. So the question is how are they pricing this? It's just futures. But if you've got $1 million of 30-year bonds left, like you can control that as the Fed. So when somebody pointed that out, I was like, oh shit, that's actually a really important point that people don't talk about. So we're talking about it here. But anyway, that gives me pause. So what are your thoughts, Phil?
So it was on October 31st, 2001. I just looked it up. And that's when they stopped issuing. So it took effect in early 2002. So it's been 25 years basically since they issued them. So yeah, there's the 30-year bonds there aren't any. Look, it feels like when we think about inflation that the bias for interest rates is to go higher, not lower. And when interest rates go up, bond prices move down because interest rates and bond values move in opposite directions. So if you're looking for yield, bonds are an okay place to be. But you don't want to go too long because there's something called duration, which really looks at how much the price of a bond changes with interest rates. And so the longer the duration is, which is essentially its yield to maturity, the more the impact is of a change in rates. So like when I look at bonds, I usually don't go out more than about 5 years. Also, the other thing that still hasn't changed a lot is like the spread in interest rates between a high quality, high rated bond and a junk bond. It just isn't that wide. I don't feel like you're being compensated enough to own lower quality. So while you might get a little bit more yield, if I look at the historical spreads between high quality and low quality debt, we're below the historical norms. So like I'm sticking more with high quality and relatively short term, like not more than 5 years, because I'm just worried about interest rate risk. Like I said, with inflation, the bias for interest rates to me is up, and that's what the data says. Now, the data is not, the surveys and all that stuff, they're not always right. Like I always tell people, I have a crystal ball, but it's cracked and cloudy, so it doesn't tell me a whole lot. But if you kind of look at what we see in the data would indicate that it's more likely that rates go higher than lower from where we are right now.
Yeah, I mean that's what everybody's betting on, and it's hard to say because the higher the rates go, the worse it is for the government, and the higher the interest payments, and it just becomes a negative reinforcement loop, right? We can't pay the interest debt because it keeps going higher, so we issue more debt, and then we can't, and that rates go higher, and we issue more debt, and the rates go higher, so it gets in this negative reinforcement loop that you can't really get out of, right? That's where like hyperinflation becomes a problem because people start distrusting the currency. We're not there yet, but at the moment, you got all the doomer and gloomers out there saying the world is ending. I've been talking about it for years, and now it's happening because interest rates are going up. I don't buy that. I agree with the thesis. Eventually, that things are going to happen, and they're not going to be good unless they come up with an innovative solution. And I've heard some innovative solutions, so it's possible to correct, but very unlikely. One of them being the Mar-a-Lago Accords, which I hadn't heard it from since, but it was basically, let's take all our debt, punt it out 100 years at 0% interest rates, and force our allies to buy it, and that's our cost for defending them. I think it's a great idea. If they'll do it, I don't know why they do it, but if they did, I think it's a great idea because we're effectively we're doing it for free now. So and we're paying them interest. Why not just they can borrow the money and they can't sell it, right? They can borrow against it with the swap line, which is what they proposed. So it's not just dead money, but they have to keep the debt. Well, that's great because then we have zero interest rates debt for like 100 years, and that'll be worth nothing in 100 years. Okay, that's a good idea. But outside of that, in normal financial, shenanigans in the U.S. government, it's an impossible situation. It's only going to get worse. So those people, the doomer gloomers, are correct, but they all talk about it happening like it's going to happen tomorrow. It's not happening tomorrow. We have so much ammunition we could try before things blow up. I did want to share this one thing because I thought it was really interesting. The Federal Reserve put this out. This is the average. These are the net worth numbers for the country. So it's on the y-axis. It's the age. So there's like basically 6-7 year brackets, 5 to 7 year brackets, about 5 years. And then you've got the average and the median. If you don't know that, look it up. You want to look at the median, not the average. You got the bottom 25%. You got the bottom 75%, or the bottom 90%, and then the top 1%. So what you can see here clearly is, if you look at 18 to 24, the average is 112,000. The median is 10,000. You want to look at the median. That's because there's some rich tech billionaires and trillionaires that are just skewing the numbers. So the median is probably the better number to look at. But
that spread, like, that's crazy. Like, I'm looking at that data and it just jumped right out at me, the difference between the average and the median. It's crazy to think how much it gets skewed by those tech millionaires or whatever they are that makes them have a lot more than everybody else. Like, they really skew the numbers a lot. Like, if you look at some of these numbers, you got 4, 5, 6 times as much when you look at the average compared to the median. I mean, median, that's a lot.
Yeah, I mean, 70-year-olds, the median is 438,000 and the average is 1.7 million.
Yeah, it's like
big difference, right? Yeah. I mean, granted, at that age, there's a lot more wealthier people, but look at 30 to 35. The average is 258,000 and the median is 88,000. Huge difference, right?
Yeah.
So, what's important to note is if you're looking at the top 1%, you can see the skew, right? The top 25% for 25 to 29-year-olds is $3,700, and the top 1% is 2.1 million. So, if you think about, like, where do you fit in this structure, right? I would say most people who are, having somewhat success or moderate success are probably in the top, 75 to 90%, right? But if you're just an average everyday Joe doing an everyday job, you're probably not in those numbers. You're probably, a lot lower. And, the challenge is where it gets in the K-shaped economy, right? If you're 50 and you're in the bottom 25%, you got a $54,000 net worth compared to somebody in the top 1% worth 13 million. That's a big spread. Person with 13 million is not worried about running out of money. Person 54, you get fired, you could be out of money in a few months. Like, it's a tough environment, and I think I point this out just because I want to share with everybody just the structure. We talk about the K-shaped economy, but this is really indicative of that. And of course, in any economy, there's going to be a discrepancy between rich and poor, and that's normal, and it should be. I know people argue with me, but there should be a discrepancy between rich and poor. Rich should be rewarded for doing things that are promoting capitalism and things that are benefiting society. If you're employing 100 people, you should get paid for that, right? The people who are just employed, you're not getting paid as much because the value is less. I'm employing 100 people. I'm giving 100 families, income to live their life. And if that's all they're doing is their own life, then they should get paid less. I'm all in favor of that. I have no issue with that. I think the challenge is that the Fed, the government, the Treasury, well, it's kind of one thing. The manipulation of interest rates and inflation on their part is, in large part, what's causing this. it's not all their fault, but their solution to the problem is their fault. And when you start to create all these financial shenanigans in the government side, it causes repercussions. And one of the repercussions is the discrepancy between rich and poor. The rich are smart enough to know that they're going to invest in assets, and assets go up in value. The poor don't have assets, so they're getting diluted through inflation. The rich can deal with inflation because they just put assets in the market and it goes up 10% when inflation's only 4%. You're making out. The poor can't do that because they don't have assets. And that's the problem with inflation. We have low inflation, everybody's kind of equal-ish. But when you have high inflation, and inflation, if it does get higher, which I don't know if it will, but if it does, the poor are going to get hurt a lot more than the rich. So just something to keep in mind. We just wanted to share that. What are some final thoughts you can leave us with, Phil, as we kind of wrap it up here?
I think it always comes down to, whenever you're looking at something in the area of finance and investing, do your own research. Don't just take the word of anybody else. But if you're not sure and you know somebody that can help you understand things, there's nothing that says we can't reach out and get some help. But you want to make sure that you understand what's going. You look for that, like, second level thinking. Don't just look at what you see on the surface. I think that's really important. Like, we talked about a lot of important things today. We talked about a lot of the financial shenanigans. Like, we have a lot of growth going on, and like, if we look at the market, earnings are really good. But can we keep financing this growth, right? Because remember, when you're financing, you're taking from the future and doing it today, right? That's really borrowing from the future, because you got to pay that money back in the future. So you're taking growth out of the future and putting it into today. So just make sure you understand what's going on. I'm Phil Weiss, and I know experiencing a big life transitions can be stressful. My job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. My firm's Apprise Wealth Management. We'd love to get to know you. You can visit our website at Apprise Wealth, that's APPRISE wealth.com, to read and sign up for our weekly blog. Thanks for having me on today, Kirk. Enjoy the conversation.
Yeah, thanks for coming on, Phil. Always enjoy your insights, especially with shenanigans. I want to part ways with a chart crime that I actually had two, but I'm just going to share this one. Chart crime on Bitcoin. I saw this promoted around, and it's a narrative to show everybody that you should be bullish on Bitcoin. As you know, I'm not bullish on Bitcoin at the moment. Maybe longer term, but not currently. Short term, no. Long term, maybe. But I see this, and it's like, wow, look at all these reading history rhymes, and they got all these annotated notes. Like, look at this. This is what's going to happen. Of course, they don't say this is what's going to happen. 2026, the news cycle begins, and it makes it look like 2026 is when things are going to shoot up. Well, as most of you who've experienced 2026, this is not accurate. There's nothing close to this. We're actually down the bottom end of this. So this looks like this was done in 2025. But point being is, when I see this stuff floating around, it's what we call propaganda. And there's tons of propaganda out there, and I'm not going to show it all, but that's one of my favorites for the week. The other one I'll share really quick, because it is also a chart crime, is this one, where they show the S&P 500 and they show a few annotations. They say, oh, look at this, deja vu, look at this channel I drew. It's got to be the accurate one, and blah, 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 blah. Okay, maybe it's accurate, maybe it's not. I don't know. But, frankly, you've gone into like 3 derivatives of where the market's going to go. Not only is it topping out, it's going to hit this point, and then it's going to drop. And then once it hits the bottom, it's going to bounce again. Like, what? Like, I mean, I get it, but I could barely detect the next move, not like the third and fourth derivative moves of this. Like, somehow you can see the future. I can't. But how does it get from point A to point B? Well, it goes this and this and this and this. Like, really? Can you see the future? Because, that's probably the thing it's not going to do, is what you just said. But, I at least have a 33% chance of being correct on the next move. It's either up, down, or sideways. I can detect that with a pretty good delineation. But if I go to the second or third derivative, my chance of accuracy is like 5%. So Yeah, I'll stick with what I know, which is I don't know anything, and I just watch the price, and the price is the ultimate arbiter. That's ultimately how you should look at the market anyway. But anyway, so we're gonna wrap it up. That's it for this week. I'm gonna be on vacation next week, but I will be delivering this probably the Monday following vacation. So I'll be on a beach somewhere, getting a little more sun and trying to relax and read a few books. So that's the show for this week. Thanks again for joining us, Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Missed something on the episode or looking for the show notes and resources? Check out our show at moneytreepodcast.com. Don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling you products or services, so do not consider this advice. If you're seeking financial advice, give us a call. We take clients selectively, but only if we like you. If it so happens that we don't like you, there are plenty of advisors out there who will work with just about anybody with a heartbeat and two nickels to rub together. Like I said, we're selective. Have a great week ahead, and remember, no one will care about you like you do, so invest in your life.